Government-enforced acquisitions are becoming more common these days. With more infrastructure being built, you might find yourself owning investment properties in the path of progress. But what does this actually really mean?
You know what this means, don't you? They're acquiring it compulsorily.
What is a compulsory acquisition? And how does CGT actually change if you ever find yourself in this situation? I'm Iannuzzelli, and welcome to What School Should Have Taught You, a podcast where I share with you all the lessons you need to know about building true wealth.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Compulsory acquisitions has been going on since the dawn of time. Again, we don't want to stop progress. We always want a country that's evolving and progressing and moving forward. But now more than ever, government here in Australia has been spending billions, if not hundreds of billions of dollars over the last 10 years, building new tunnels, new roads, freeways, light rails, and airports in the last couple of years alone. This is something that a lot of people need to understand, that if your investment property sits in the path of progress, where the government has to compulsorily acquire your particular property, you need to know the tax implications that you might be impacted with as you move forward. I want to share with you some things that you won't often hear around the barbecue, and your accountant often won't talk to you about it. These circumstances may not regularly appear to you or your friends, but it's always good to be informed if they do. Compulsory acquisitions, especially here in Australia, have been happening, as I said, more than ever before. Now, if the government has to tap on your door, and let's say it's the state government or the federal government for a state or federally funded project, then you need to be aware that they will take your property and pay you a market value for it. It's been happening for a long time. In most circumstances, when someone comes in and buys your investment property, we do have a capital gain tax event that applies. You've sold your property to the government, being the purchaser. You have a cost base attached to it, and I've gone through this show many times to share with you how to calculate your capital gain tax. But this time it's been taken from you from a compulsory acquisition point of view. So what are the available functions that you have at your disposal? Well, a little known thing. It's called a 2-year acquisition plan. If the government has compulsorily acquired your property, you've got up to 2 years to buy another property at similar or potentially more value where no capital gain tax CGT applies. So essentially what that means is you're rolling over your cost base into a new asset because there's special legislation that allows you to do it because you've had your property acquired by the government on an acquisition basis. So it's important to note that if you're buying a property at similar or potentially slightly higher value, you can roll that CGT over to the next asset. If you happen to buy a property which is significantly lesser in value, then there will be a proratement of capital gain tax. So it's important to really sit down with your accountant at the time of receiving the acquisition notice and making sure that you plan accordingly. Generally, these acquisition notices don't come overnight. You may be given months, if not potentially even years, to find other properties in that particular space. Sometimes governments can bring forward the date, or you can actually bring forward the date. So don't feel that there's a pending date which they need to have your property being acquired. Sometimes you can bring this forward. It's all part of the negotiation. And that gives you an opportunity of maybe being able to roll that wealth over into another property and give you a very unique opportunity to pivot with potentially no capital gain tax on the transaction. So it's very important to note that if you do have an acquisition that pops up in your particular area and your property is impacted by progress, don't look at it as a negative all the time. Look at it as an opportunity to maybe pivot and move it into a different direction, because you do have up to 2 years to find another property at equivalent or slightly higher value and roll that capital gain tax into that property in the future. Keep in mind, if you do get compulsorily acquired and that property needs to be sold and you find another property at a significantly lesser value that you wish to buy, then capital gain tax will apply. If you choose not to do anything and just simply take the money, capital gain tax is applicable as any other normal sale would be. So if you find yourself in this situation, don't panic, don't hide under the bed sheets, but use this as a great opportunity to potentially pivot in another property where you can roll the capital gain tax over. Keep in mind, you don't necessarily need to buy another property. You can choose to take the cash and pay the capital gain tax like anyone else would, but it could be a great opportunity at your hands. I'm Iannuzzelli, and this is what school should have taught you. I look forward to seeing you in the next episode.